trend analysis is a concept of technical analysis used by traders to forecast the future price fluctuations of an instrument based on past data. Trend analysis is based on one of the pillars of technical analysis: history repeats itself. With trend analysis, we try to anticipate future movements by analyzing the past. Trends identified in the past that has proven to be valid at one time would also work in future and will help to anticipate future trends. A trend is a prolonged market movement in one general direction, either up or down. A trend is basically the general direction of a market. On a chart, a trend is usually formed by a succession of higher or lower trading ranges. An uptrend marks a succession of higher highs and higher lows, while a downtrend marks a succession of lower highs and lower lows. A trend may last for a matter of days, weeks, or months, depending on the time frame analyzed by traders. Identifying the current trend direction is a very important phase in trend analysis. The fundamental pattern of a trend on any time frame is this: a movement in one direction, a retracement in the other direction, and another leg in the original direction. Whether we look at trends on the 1-hour chart or the weekly chart, we will find the same structure. The significance of the trend will vary depending on the analyzed time frame. There are three types of trends. The primary trend, which represents an extended ascending or descending movement that usually, but not always, lasts for a large period of time. Movements in the direction of the primary trend are interrupted by secondary trends in the opposite direction. These are also known as pullbacks or corrections that occur when the primary trend recorded a steep slope. In their turn, the secondary trends are composed of minor trends. A primary trend is considered as ascending, bull market, when each successive increase reaches a higher level than the previous one, and each secondary correction stops above the previous one. In other words, an upward trend is a succession of higher highs and higher lows. A primary trend is considered as descending, bear market, when each successive intermediary downward move leads to successive low levels and each secondary correction stops below the previous one. In other words, a downward trend represents a succession of lower lows and lower highs. Secondary trends, also known as intermediate trends, are relevant corrections that interrupt the price evolution in the direction of the primary trend. In a primary upward trend, the secondary trend will be a downward move, also known as a pullback. In a primary downward trend, the secondary trend will be an upward move, also known as a rally. In general, a secondary trend corrects between 1/3 and 2/3, most likely around 50%, of the increase or decrease of a primary trend. Minor trends are short-term fluctuations that have a lesser importance. The minor trends form the secondary trends. Usually, but not always, a secondary trend consists of 3 or more minor trends. Most traders focus on the primary and secondary trends, and here's the reason why. Minor trends often include a considerable amount of market noise. When you focus on minor trends, you can get caught by short-term volatility and lose focus on the bigger picture of the trend. Understanding market cycles will help you to better identify trends. It is believed that the market prices move based on the psychological perspective of two main groups: the so-called smart money and the general, uninformed public. There are 4 phases of a market cycle. Accumulation phase consists of sideways price action, during which smart money players buy carefully and skillfully, without moving the price. The uninformed public is unaware of what is going on. The markup phase represents the classic uptrend. At this point, the uninformed public becomes aware of the price movement, and start to buy, driving prices higher. Smart money players who bought during the accumulation phase may take some profits into the strength of the uptrend, or they may hold and wait for higher prices. The market enters the distribution phase when the trend ends. In the distribution phase, the smart money players sell their positions to the uninformed public who is anticipating higher prices. A part of smart money players might even sell more than they own and short the market. On the charts, the uptrend runs out of steam, and the market goes into another sideways trading range. To the uninformed public, distribution phase is not very different from accumulation phase. The markdown phase represents the classic downtrend that follows the distribution. Smart money players who shorted during distribution phase will buy back some of their shorts into this weakness. Eventually, the uninformed public panics and sells their positions. A market cycle is dependent on the time frames analyzed by traders. An accurate analysis of the market cycle will help traders to better understand the trend. In the perfect scenario, You would want to buy during the accumulation phase and sell during the distribution phase. However, it is difficult to pinpoint entries in the accumulation phase. A more realistic view would be to buy during markup phase and sell during distribution phase, or at the beginning of the markup phase. As long as you squeeze some profits from the market, you'll be fine on the long run. In order to determine a trend, you must master the trend lines. Trend line analysis is often underestimated by traders because it is perceived as being subjective. Although this is not false, the trend line analysis should be the first step in determining the existence of a trend. Trend lines are straight lines drawn on a graph connecting support points for an uptrend, or resistance points for a downtrend. A trend line may rise, fall, or move sideways. Trend lines connect two or more support points that define the trend. Drawing trend lines is subjective, is not a precise science. Draw them correctly and you'll have an edge over the market. In an uptrend, we look to connect the lows of the price. In a downtrend, we connect the highs of the price. A valid trend line connects two or more points that define the trend. We start drawing trend lines on higher time frames and carrying them forward to shorter time frames. We identify the areas of support and resistance, the most significant levels being on the higher time frames. An uptrend line has a positive slope and acts as support. As long as the market price remains above this trend line, the uptrend is considered intact. A close of the price below the uptrend line suggests that a change in trend could be on the cards. A downtrend line has a negative slope and acts as resistance. As long as the market price remains below this trend line, the downtrend is considered intact. A close of the price above the uptrend line suggests that a change in trend could be on the cards. The relevance of a trend line depends mainly on its length, its number of retests and its ascending or descending slope. The length of the trend line is an important factor. A 3 to 4 weeks trend is of minor importance if the trend lasts for 1 to 3 years. For example, a break below or above a trend line with an important length represents an important signal. A trend line is more important if it has been retested many times. That's why a trend line acts like a dynamic area of support or resistance. Each line retest contributes to the importance of support or resistance. Extending the trend line after a breakout is very important because its role of dynamic support, resistance will reverse. This means that if an uptrend line retested several times in the past is broken to the downside will become a resistance area. Also, if a downtrend line retested several times in the past is broken to the upside will become a support area. A very steep trend is difficult to be maintained and is therefore likely to be easily broken, even by short lateral movements. All the trend lines are eventually broken, but the steepest trend lines are the soonest broken. Usually, a breakout of a trend with a steep slope is more likely followed by a trend continuation than a reversal. A steep trend line is the result of an accelerated increase or decrease in price in the short term. In this case, the trend line will have a higher angle and is less likely to provide solid support or resistance. From my experience, trend lines with 30 to 45 degree angles represent solid indicators for the main trend.